All right, let's get right into it. Starting in 2027, a huge shift is about to hit the world of accounting. It's called IFRS 18, and it's going to completely change how companies report their performance. And I'm not talking about a small update here. This is a total rethink of the entire philosophy.
For years, companies had a lot of freedom to tell their own story about how profitable they were, using all sorts of custom, adjusted numbers. Well, that whole era, it's over. A new global standard, IFRS 18, is stepping in, and it demands one thing above all else: clear, comparable data.
So, you might be asking, why the huge change? What was so broken about the old way? Well, to get that, we need to go back and look at the thinking behind the old standard, IAS 1. Its whole philosophy was built on one single idea: freedom.
And this is where you can really see the clash of ideas. The old way of thinking was, hey, every business is different, so let them define profit in a way that makes sense for them. Sounds logical, right? But the new philosophy, which is really driven by what global investors need, says, nope, comparability is king. A single structured standard is now the top priority.
And that freedom, it created a massive problem. It led to this absolute jungle of adjusted profits and core earnings. If you were an investor trying to compare company A to company B, it was a complete nightmare. And this wasn't just a small headache. It was basically a cry for help from the market for one single reliable measuring stick.
I mean, just look at this. It shows you how deep the problem really was. Profit wasn't just a number, it was shaped by culture. In the US, it was all about the investor, so you'd strip out financing to see the pure business. But in Japan, it was all about ordinary profit, or kitsune. Could the company pay back its debts? China saw managing assets as a core activity, while Germany was focused on the factory floor. So trying to create one single IFRS definition meant trying to bring all these different worlds together.
So how in the world does IFRS 18 cut through all that complexity? Well, it does something that IFRS has actively avoided for decades. It introduces a mandatory, globally standardized definition of operating profit.
Which, of course, brings us to the million-dollar question, the one investors and accountants have been debating for years. What in the world is operating profit according to this new global rulebook?
And the way they answered this is actually pretty brilliant. Instead of trying to write a definition for operating, which, let's be honest, people could argue about forever, IFRS 18 defines it by exclusion. It takes this very logical approach by telling you exactly what operating profit is not.
Okay, so how does this actually work? It's basically a simple subtraction problem. You start with everything, all your income and all your expenses. Then, you surgically remove anything that fits into the new, strict definition of financing. After that, you take out everything from the investing category. And what's left over? Bam! That is your operating profit. The key thing here is that it takes the guesswork and the subjective judgment out of management's hands. And the results of this is so powerful. By clearing out all of the noise from financing and investing, you're left with a clear picture of how the core, day-to-day business is actually doing. This gives investors a real apples-to-apples comparison between any two companies reporting under IFRS, anywhere in the world. For financial analysts, this is basically the holy grail. But the rulemakers also get that a single number doesn't always paint the full picture. So they built in a compromise, a way for companies to still give their own perspective, but this time with some new guardrails. That's right, companies can still show you their custom-made profit numbers. They haven't lost that freedom entirely, and this is a big but, there's a catch. The days of just dropping these numbers in a press release and walking away are gone. So what do we call these things? Well, now they have an official name: Management Performance Measures, or MPMs. This covers all those numbers you're used to seeing, like adjusted EBITDA or core profit, the ones management says you really need to see to understand their performance.
And here's the catch. If a company wants to use one of these MPMs, they now have 3 new rules to follow. First, they have to put it right there in the notes of their audited financial statements. Second, they have to show their work with a table that reconciles their number back to the closest official IFRS number. And third, they have to explain exactly why they think their custom number is useful. It's a massive shift from freedom to full accountability.
And here's just a quick example of what that reconciliation looks like. If management really wants to show you their EBITDA of $1,200, they now have to lay it all out, showing you exactly what they took out, like depreciation and restructuring costs, to get from their number to the official IFRS operating profit of $800. It's all about transparency. No more black boxes. So the bottom line is this. All of those unique stories and custom numbers that used to live in a PowerPoint deck for an investor call, they're now being dragged into the official audited financial statements. They're not just part of a marketing pitch anymore, they're part of the formal record, and they're going to be scrutinized.
And make no mistake, the impact here goes way beyond the accounting department. This new standard is going to create ripples that spread through the entire organization.
Just think about it for a second. If the official definition of operating profit changes, what happens to all the executive bonuses that are tied to it? They're going to have to be redesigned. All the internal KPIs you use to measure performance, those have to be reevaluated. And of course, the big one, all the IT and financial systems that pump out these reports will need a major update. This is a strategic challenge, not just a compliance checkbox.
So as we wrap this up, it's pretty clear that IFRS 18 is way more than just a new accounting rule. It's really a new, fundamental question for every single company out there. In this new world of transparency and comparability, how are you going to define, measure, and, most importantly, communicate your performance to the rest of the world? That's the big question everyone needs to start thinking about.